Homegrown Bitcoin ETF provides investors with a regulated pathway into the cryptocurrency market.
When you're ready to take your investments to the next level, you might want to consider Monaco.
Hello and welcome to the Global View. On this Monday, I'm Andrew Gagan. Great to have you with us here at ausbiz to start a brand new week. Well, let's first take a look at where we finished last week. Global stocks, of course, finishing a very turbulent week. They ended higher on Friday as investors refocused on interest rate cuts and those bond yields eased. On Wall Street, the tech sector boosted the broader market, while the CBOE volatility index, or fear gauge, did fall quite dramatically after, of course, spiking to its highest level ever there. For the week, the S&P 500 ending flat, the Nasdaq was off by 0.1%, and the Dow lost just over 0.5%. Sector-wise, industrial and energy stocks were the best performers, while consumer discretionary and materials were the worst. Among the Mag 7 stocks, Apple and Meta were the best performers. Also, Expedia shares surging after the online travel agency beat analysts' expectations for second quarter profit. Video game publisher Take-Two Interactive Software advanced on forecast that net bookings will grow in fiscal years 26 and 27. And electric truck maker Nikola beat Wall Street expectations for second quarter revenue and posted a smaller than expected loss. Now this week, Walmart and Home Depot are among companies reporting earnings, with their results seen as a snapshot on US consumer spending. Well, longer-dated US Treasury yields fell on Friday to round out a volatile week driven by concerns about the US economy. Markets this week will turn their attention to key inflation data out of the States for clues on the size of an expected September rate cut. Fed member Susan Collins has said, if the data continue the way that I expect, I do believe that it will be appropriate soon to begin adjusting policy and easing how restricted the policy is. Well, the US 2-year Treasury yield was at 4.06%, the 10-year falling to 3.94%. Markets are now pricing in a 50% chance that the Fed funds rate will be cut by 50 basis points at next month's meeting. US dollar lower against other major currencies on Friday and down against the yen, the Aussie slipping to 65.7 US cents. All right, so let's get across all those market moves and what is driving it. Anthony Doyle joining us from Firetrail Investments. Anthony, welcome back to ausbiz. Good to catch up with you again. How would you round out where we've been that past week and just what's going on global markets at the moment?
Yeah, really a multitude of factors coming to a head all at once. And it goes to show you the marketplace, it's the interaction of many different buyers and sellers with different time horizons and different motivations. So for long-term investors, arguably it's been an opportunity to top up some of their positions in risk assets like equity markets, whereas those shorter-term investors have obviously been hit by significant volatility over the course of the last week, with markets actually over that week remaining flat. So big central bank moves, when the BOJ moves for the first time in terms of hikes to positive territory, that's going to cause ructions in global markets. We have obviously speculation around the Fed, not if they're going to cut, but by how much. And we've also thrown in a Bank of England rate cut in there as well in the last couple of weeks. So big things that investors are considering, and it really has been macro at the forefront driving markets.
Do you feel as though those concerns about where the US economy is tracking right now are well founded?
Yeah, absolutely, Andrew. And, markets typically lead, whether it's the bond market or the equity market, in terms of central bank thinking. We only have to think about, cast your mind back to RBA forward guidance and what a disaster that has been. And markets have proven right. The RBA would have to hike and hike indeed that they did. But certainly it does look like monetary policy is at a restrictive setting, and the US consumer as the engine of growth of the US economy in terms of GDP growth is 2/3 consumption, I think it's right that some of the weakness that we've seen really over the course of this year is starting to come to the forefront of investors' minds. And with that in mind, in the traditional winners over the course of the last 18 to 24 months in terms of what's led the stock market, they've come under pressure, and you've seen that rotation occurring really as Jay Powell has intimated the Fed is increasingly close to cutting rates.
Yeah, in fact, I see you point out that because we will get a read on inflation out of the States this week, but you're saying that's going to be less important actually, perhaps, rather than the read we're going to get on retail trade, and also we're getting a couple of key companies reporting in that sector as well.
Yeah, post-COVID, it's always, it's all been about inflation, and the most volatile trading days on equity markets in particular have been around those US CPI prints. But now, certainly, it looks like the trend is your friend. Inflation is quickly coming back to that PCE level of 2% that the Fed targets. And certainly the Fed has intimated that their dual mandate, the focus has certainly been on inflation, which has seen those rate hikes come through. But now they can shift their focus to the other side of that dual mandate, which is full employment. And the Fed has historically been highly attuned to weakness in the labour market. And all of a sudden, everyone's an expert in the SARM rule as well. And that obviously triggered and has always triggered before a US recession. So with that in mind, they do have substantial policy ammunition that they can deploy if they see those concerns over the labour market increasingly begin to become more worrisome and the unemployment rate begin to pick up.
So Anthony, given that sell-off we've seen in the past week or so, plus of course that rotation was already underway, where are you actually seeing the opportunity at the moment?
Now, we're certainly in a world where, whilst I mentioned that inflation is becoming less important, it's certainly not returning back to those pre-COVID type levels. So interest rates are likely to remain relatively higher than we've become used to in that post-GFC environment. We are about to enter into a rate cutting cycle. EM central banks are there, DM central banks are cutting rates, but there will be a cost of capital and there will be winners and losers, not only in bond markets, but of course equity markets as well. So for us, the key is to focus on those companies that have robust earnings profiles, that have sustainable earnings. They have robust business models, they have sustainable business models, and importantly, they're trading at relatively attractive valuations. And the area of the market, the global equity market, that's really screening at the moment in our models is the mid and small cap part of the market, particularly for companies such as HVAC manufacturer Train Technologies, benefiting from commercial corporate upgrades in terms of energy efficiency and implementing more efficient HVAC units, which is helping to drive down energy costs and, of course, carbon emissions. Another company that we've seen generate significant earnings upgrades over the course of the last 12 months is a company like Ryan Specialty Group, specializing in a niche part of the insurance market called excess and surplus insurance. And these are hard to insure risks like cyber and climate change risks such as erosion on coasts and building and property maintenance and insurance there. So there are opportunities for investors with a medium-term time frame looking 3 to 5 years forward to get set in some of these positions and generate meaningful alpha over the course of those 3 to 5 years.
Overall, at the moment, Anthony, how is your portfolio position? What sort of levels of cash are you carrying at the moment?
Now, Andrew, one of the things that one of our philosophies is it's extremely difficult to time the market. So typically we're fully invested throughout the course of the equity cycle and the economic cycle. And there are investors that like to time the market, so we let our investors do that should they wish to do that. So we're fully invested. In terms of the mega cap part of town, we own Nvidia, we own Apple, we own Alphabet, but generally we're underweight the largest cap or the mega cap part of the MSCI World Index, and we're overweight that mid cap part of the market. In terms of the region by region, the most significant valuation opportunities today are really in Europe, despite the leadership that the US has shown. But we are expecting that as you start to see rate cuts come through, earnings upgrades to continue to be seen. And the most recent earnings season has shown that 80% of companies in the S&P 500, for example, have actually beaten expectations. So the cycle can be elongated by policy ammunition from central banks.
There is a lot of focus at the moment on AI, that thematic that's been playing out, of course, and as a result, we have seen those mega caps lift. But concerns about how immediate those returns are going to be, do you share those concerns? I mean, you mentioned those companies you're in at the moment. How are you seeing the immediate future?
Yeah, so definitely, AI, there isn't as of yet a killer use case in terms of AI enablement, and it is really an arms race in terms of capital expenditure. So the big question for investors is, what's the ROI on this huge amount of capex that we're seeing from many of these AI enablers, like a Microsoft, for example? But for us, one thing that is unquestionable is that we are going to require significant hardware in order to run many of these AI tools that are being developed on our devices. So for example, Apple Intelligence, Apple have said that only 5% of their devices can actually run Apple Intelligence on device. And there's significant advantages of running Apple AI on your device, which is really latency, so you're not sending queries to the cloud, for example. So we do expect an upgrade cycle to come through for AI devices, including the iPhone. And really the winners are semiconductors. So, a TSMC, for example, also AMD, for example. These are companies that are likely to see continued significant demand for their products as we see that processing power compute, as we see that demand continue to grow.
Anthony, terrific to get a view of your outlook from Firetrail Investments. Thanks for joining us.
Cheers, Andrew.
Let's take a look at where we're likely to get going in a couple of minutes' time. SPY futures a healthy 0.75% higher. And we'll get right across that when the market opens in just a couple of minutes.